Hey, most real estate investors are waiting for the perfect time to buy, but while you're looking at Zillow or LoopNet, commercial appraisers are looking at the actual bank records. And today what we're going to be talking about is how to determine whether or not that commercial real estate deal is a great deal for you. And that's why I'm bringing on a commercial appraiser, Megan Manke from Kidder Matthews. We're going to talk about the valuation floor really isn't happening in 2026 and whether buildings are becoming unbankable and how that $1.5 trillion maturity wall that everyone's been talking about, is this going to create for you a huge buying opportunity or is it going to be a disaster of the decade? All right, guys, let's get started. Megan, hey, thanks for coming on. Why don't you just start off by telling people a little bit about yourself and what you do at Kidder?
Sounds great, Clint. Thanks for having me. As you said, my name is Megan Manke. I'm a certified general commercial real estate appraiser for Kidder Matthews. We're in Seattle and headquartered in Tacoma, Washington. I graduated in 2020 from the University of San Diego with a degree in real estate, and I started my career as an intern while I was in college for Valbridge Property Advisors in 2018. I then started interning with Kidder Matthews for the summer of 2019 before beginning as a trainee appraiser there in the fall of 2020. I appraised a very wide variety of properties, including office, retail, industrial, apartments, self-storage, churches, even some equestrian centers and vacant land. And I've also assisted in research for national data center properties. I'm currently working on getting my MAI, the highest professional designation awarded by that company. It takes around 5 to 10 years. You have 400 hours of classes, 11 exams, 4,500 hours of experience, and then a final report.
Wow, that's a lot.
It's a lot.
I forgot to say, and I've known you for now, what, 20 some years?
I think
Watching you grow up.
26 or 25. Yeah.
Yeah. So that's a great thing seeing you grow up and mature and come into this position. And
Yeah.
I'm just glad you're able to squeeze some time out for the viewers today to
Yeah.
talk about your experience in commercial real estate.
Yep.
Okay, so here's what I want to start off with. Okay, the
Okay.
replacement cost gap, right? In
Okay.
2026, what I've been hearing is that many Class A assets are trading below what it would cost to build them today. And so I want to know, is that an accurate statement from your side? And as an appraiser, how do you value a building when the cost approach is going to be higher than the income approach?
Yeah. So obviously, what it costs to build is going to be really expensive, especially in today's market when costs are so high, labor is so high. All those factors play into what that building is going to cost. And we only really do a cost approach if we're going to value a specialized property like a church or a school, or if it's a brand new build. And typically there is going to be some economic obsolescence to that. So that's what you see in the sales and income approach might be a lot lower than the cost approach, which alludes to that point. And we try to reconcile between that because you don't want buildings to cost more than what they're worth. But if it's going to cost that much to replace it, you might have to make some sort of adjustment and look at the long-term cost of owning that building and what the rent you're going to get from it is. Does that make sense?
It does. And so are you seeing many people who are attempting to build?
I think construction slowed down a lot. There was a lot of construction right when COVID hit because people weren't going into offices so they could renovate properties or they could add on to properties, or they were building a lot is something you could still do where people weren't going into offices. I think just in the natural economic cycle, we've been slowing down. I don't know how much is due to what's actually been going on because I'm not making those decisions. I'm just observing what I'm seeing. But I definitely think that people are slowing down construction. In the South Sound, particularly, industrial slowed down a lot, but I think that's because they built so much in 2020 and 2021.
Okay, so that's a really good point. So when we think about, what happened in COVID and there's all these years of hybrid work,
Yeah.
so are you still giving office space, commercial space, the same valuation weight? And I'm not talking about the specialty stuff, we'll get into that, but I'm just talking about general commercial space. Are you giving it the same weight as you did maybe 36 months ago? Or has there been some permanent vacancy risk that's changed the valuation factors in what you're doing?
So traditional office is its own asset class right now. It's so different than any other type of property we're seeing. It's hard to tell. It depends so much on the market. office in the South Sound, like Tacoma and other suburban markets, is performing so well. So you also can't just say office is terrible, don't invest in it. Downtown markets like Seattle are struggling a lot, but not as much in Bellevue. And that has to do with different economic policies. There's more taxes in the state of Seattle, or in the city of Seattle. So businesses are moving to Bellevue because there's less taxes, like the new head tax that's coming out. Or during COVID, a lot of people moved to more suburban areas because they weren't going into the office every day. So they didn't want to pay these big rents to live in the city. And companies realized that and were like, well, we're going to open an office in Tacoma because more people moved down to the South Sound. So it just depends so much on the individual market, not as much the asset class, but it does depend on the asset class too.
Okay, so for the viewers, I'm in Washington State. What she's referring to is that you know where Seattle is, which is a urban center, but the tertiary markets, it sounds like, is what you're telling the viewers is where you're seeing opportunities, and where you're on the appraisal side, they're really holding up there. Is that a fair statement?
Correct. Yeah, and vacancies are a lot lower in those tertiary markets where they're a lot higher in downtown markets. And it's just how things have changed since COVID. It totally disrupted the whole view of everything.
Yeah, which is something that people that watch my channel, you'll know, I'll say, hey, investing in blue cities and blue states, it's always a risk because they do just what Megan stated. They'd like to throw taxes on top of real estate investors and people and businesses, and it makes it hard to turn a profit in that instance.
Yeah, it can make it harder.
So you are seeing that. Interesting. So with the cap rate stabilization, the Fed's talking about moves recently, are you seeing anything there as far as the cap rate stabilizing, or is there still upward pressure?
It seems like there's still a little upward pressure. It's hard to tell because we are so far down the food chain. So first investors have to hear that the cap, like there's going to be more rate cuts and we're going to do this. So then they're going to start looking for buildings. Then more buildings are going to transact. And then I start to see it. So I haven't started to see it yet, but I probably will in a few months as investor sentiment keeps growing and more positive. But I do think it's moving towards that way.
Well, what about lenders demanding a higher risk premiums on their loans? Are you seeing anything in that area?
A little bit. Lenders are a lot more cautious right now, especially in the last probably 18 months. We've seen asking for more than just looking at cap rates in the area. They also want to look at different performance indexes or some charts and just present more data to say, this is why we think the cap rate is this way.
Okay, so when you talk about charts, are you referring to, I've heard that you guys have an adjustment grid that you use. So can you explain first off what the adjustment grid is? And then I would like to know, what is the biggest negative adjustment that you're probably running into right now that, maybe investors are ignoring or they need to be aware of?
Yeah, so when we do an adjustment grid, that's in the sales comparison approach most commonly. And that'll be, we look for comparable sales in an area. So say I'm doing an office property in Seattle, because we've kind of been talking about that. And I'll try to find as many recent office sales as I can in the area. But in this day and age, like I said, there's not many properties transacting. So it's getting harder and harder to find those good comparables. And if I'm looking at a 40,000 square foot property, I'd like all of my properties to be around that size, because the more differences it has, the more adjustments I have to make. And that just makes it harder and harder to be as sure in my position of what the property is worth if I have to make an adjustment for every little thing. So we'll make adjustments like market conditions. Say it's 3% a year or 5% a year, or if it's office, maybe negative 15% a year or something crazy like that. And we'll make adjustments for financing. If it's an odd financing structure, we want them to represent a cash deal because that's the best equal standard you can go across all properties. And we'll make adjustments for location, age, quality, condition, function, frontage, if it's on a corner, if it's mid-block, parking, land to building ratio, those kind of things.
So what's the biggest negative one? So if I was an investor, I should be aware of if I'm looking at this asset class?
It really depends on the property. I go property by property, and the biggest negative ones I've seen is probably market condition adjustments for office in the city of Seattle. because in 2019, an office building downtown was worth 3 or 4 times what it is today. That's just what has been going on. But typically, we don't do too many large adjustments. If it's a really big land property in a rural area where there's not a lot of sales, I'll maybe do some bigger adjustments for size. But typically, it's anywhere from 5% to 7.5% is the biggest we see, but most are 2.5% to 5%.
So, okay, so going back on what you said earlier, you said there's a flight from Seattle
Mm-hmm.
and prices are significantly down compared to what they were in 2019.
Mm-hmm.
But do you see any, maybe you wouldn't see this, but is an interest still, despite economic conditions in the cities, of where people are they're starting to hit a bottom, you think, where people are going to start coming back into the market and looking to pick up these properties?
I think so. More offices are going back to full-time work, like especially in Seattle, Microsoft, Amazon, they're now requiring 5 days a week, I'm pretty sure. And as more
Mhm.
people are coming in, they need to increase that space that they let go after COVID. I'm not saying it's going to happen right away or anytime within the next 3 to 5 years, but I think those spaces will become more and more desirable as we go back to more normalcy after COVID. And we're slowly starting to hit that turning point where it's coming back.
What about insurance? So
Okay.
if you look at markets, Florida, California,
Mhm.
have any issues with insurance here in 2025, 2026? And do you know of any issues where buildings have become worthless because they can't insure them?
Not that I've heard of. I haven't done any sort of appraisal for solely insurance purposes. So I'm not saying that hasn't happened at all. I just haven't seen it. Um, Most of what I do is for like bank loans or private parties who are looking at assets and seeing what they have and what's going on. So I haven't seen that. I just know at least what we've seen, insurance costs are so much higher than they were year over year and they keep rising. And that's a big thing for landlords and property owners.
Got it.
Hmm.
Okay, so something that intrigued me is that Washington State, like a lot of states, have started
Hmm.
imposing, green laws, and there's that ESG premium that kicks in.
Hmm.
And so I'm curious, in your recent reports, do buildings with high energy efficiency ratings actually command a lower cap rate or higher valuation, or is it still just, politicians fluffing the market?
It depends. So
Yep.
obviously, if your energy costs are so much lower, that's going to go into our income approach because that's an expense. So if I have a really high energy efficient building, my energy costs are going to be lower than most properties, which means the amount of expenses for my property are less. So that rent minus expense, my NOI, is going to be a little higher than a similar property that has a similar rent and all other similar expenses. So I'm not exactly adjusting the cap rate for that, but it trickles down into the value because of that. Does that make sense?
It does. But do you see
Yeah.
many green projects taking place or buildings where people have been upgrading them? Or is it just still kind of too expensive for a lot of building owners to even touch?
I think building owners, from what I've seen, haven't been upgrading them on their own accord so far. It's mostly just been if they're needing to build a new building and they have to meet these green standards, or if they're renovating in the city or county, whoever's doing their permitting says you need to have this many electrical vehicle chargers or these special lights or that is when owners are doing it. I haven't seen anyone going out and doing it just on their own, just to lower their costs.
Got it. So if they're
Mhm.
looking to repurpose the asset, do major upgrades, then the city steps in and they say, all right, we're going to permit this, but in order to do that, you have to do all these green things at the same time.
Yeah.
That's
Yeah.
probably,
That's mostly what I've been seeing.
huh. How about obsolescence? Is there any features you're finding in older buildings that make them obsolete? And then that's kind of tailing into what we're talking about with the green stuff, where, if an investor, because a lot of the people that, watch this channel, they're looking for real estate deals. But is there, when they're looking for these commercial deals, if they want to get into that segment, are there things that, I as an investor might miss, but a bank would penalize me for because the building might be considered obsolete or aspects of it?
Yeah. So, portions of buildings, when we look at obsolescence, we look at it as a form of depreciation. So, one
Mhm.
form is called functional obsolescence. So that's if it's just not the most functional building we've ever seen. And that could be things like confusing hallways, which you see in older buildings where it's hard to reconfigure the layout for different tenants. Like when I'm looking at an office building, I want to think about, okay, well, I could lease this floor to one tenant, but if I can't get another tenant in there, how can I break it up in a cheap and well thought out way for 3 or 4 tenants? So we kind of look at it that way. And then what was the second part of your question again, going into functional obsolescence?
Well, just basically what an investor should be looking at,
Mm-hmm.
when they're evaluating a building, because you go forwards with this, but then the bank's going to penalize you because, as you just stated, and then I need to bring more cash to the table if I want to put that deal together.
Yeah. Basically, there's a lot of different things that appraisers spot that a bank's not going to see. A bank's typically not going to walk through the property, and they'll look at rent rolls, they'll look at leases, and they'll kind of have a general idea on what it's worth based on the information provided to them by the investor. But when I'm writing a report, I'm taking hundreds of pictures and I'm describing each one, and I'm talking about the roof, when the roof was last replaced, when they've done any recent capital improvements, the HVAC, the different kinds of systems, the flooring. If this tenant moves out, how risky is it to get another tenant in? Things like that.
Got it.
Mm-hmm.
So, with tenants moving out, and you're thinking of the properties, you seeing many anchor tenants leaving properties right now?
Not too many. I haven't done any mall spaces, so I can't speak in that, but I know that that's mostly in the news of Nordstrom getting out of places or other big box stores. I've done a couple grocery stores recently, and those are really stable long-term assets. It's a lot of long lease terms, like 25 years or more. I think the biggest I've seen is 60 years, which is just insane. So I think grocery's really stable, but I can't speak. Malls are just so up and down these days, and they're a little riskier. Mm-hmm.
So, if I was considering getting into commercial real estate, what would you recommend I look at? What do you see? What do you see? And you say, hey, these are really good performing assets, and they're appraising well.
Yeah, medical office lately has been, and especially in our area, has been really strong. They have good high occupancy rates, and it's a lot of long-term tenancy. They'll be on longer 5 to 10-year leases because their spaces are so specialized and they're putting so much money into it themselves. They don't want to move that often. And also, as baby boomers get older and older, there's more demand for outpatient services. I think construction for medical office is kind of falling to lows because we built a lot of it again in 2020, 2021. So that'll help tighten the supply and push the rents. Cap rates on these properties tend to be tighter, and valuations are stronger because of the cash flow and the limited supply and the tenancy. So even in more volatile markets, medical offices tend to outperform.
Got it. So what I'm hearing is I need a grocery store and I need a medical office.
Yeah.
To get into this space. How about, have you seen any data centers? Because that's in the news right now. Read the Wall Street or whatever.
Yeah. So I actually have a supervisor who I work with at Kidder Matthews called David Chudzik, and he does data centers all over the country. He writes a newsletter, on data centers every, I think, month or year. Not exactly sure. Data centers construction really has grown in the past few years, especially in 2020, 2023. I think they're a great asset class if you can get into, because as we get more into AI and more technology driven, we're going to need more and more data centers to store all that information. But I definitely think construction's slowing down on that aspect.
Well, those would have to be positioned too where you have cheaper power. So like on the eastern side of Washington State.
Yeah.
You get the BPA
mostly
power
in
breaks.
Quincy and Wenatchee and East Wenatchee. We see those in Washington State. But you also see them in Chicago and Virginia and Texas. And they've been converting, at least in Chicago, I worked on a couple properties where it was old office buildings that weren't being used to data centers in the city, which is very interesting because it's expensive power, but you don't have to run it as far to get to where it needs to go.
Okay, because that's close to the grid.
hmm
So with banks, now I want to switch over to talk about, financing and what they're doing. So you you had a lot of people get into these loans, right?
Yeah,
And they've had these loans for many years and now they're coming due. But I've been reading that banks have been extending them in certain instances and they're giving them
yeah.
2-year extensions. So are you seeing much of that?
I haven't seen as much of it because I don't really know what the terms are going to be when I get an appraisal. I don't know what the bank's thinking, what they're doing it for. I know that it could be for a refinance, but I don't know it's going to be for a 5-year refinance or a 2-year refinance. But I've heard people talking about when I'm on tours, I kind of ask, like, why are you getting an appraisal? What do you need this for? And some of them have said that they are getting some extensions. I think banks are a little more selective. They're not giving as loose of covenants, and we're expecting a few more maturity defaults where owners can't hit that new debt to yield hurdle. So that might hurt the debt service coverage ratio a little bit.
How about liquidation values? Are you doing any of those appraisals?
I haven't yet. For the last 3 years, people have kept saying, oh, you're going to get all these appraisals coming
Yeah.
in from the market. But I think I've only done one or two. So I haven't seen as many of them as everyone has thought. So the economy is doing better than people think it is. But I think everyone's just kind of right on the edge of where it's going.
So one thing that comes to mind, I've been reading more about conversions, right? Where they're taking offices, converting them to apartments and some of the challenges with windows and things like that
Yeah.
to make these conversions. So are you seeing that right now?
People are trying to do it.
hmm
There's a couple just starting in Seattle. I appraised one 2 years ago and they haven't started construction. They got the funding, but they haven't got permits. What makes those hard is you have to find the perfect building. Because with an office building, you can have people in the middle of the building. They don't need windows. They don't need all that stuff. But if you're going to turn it into apartments, every bedroom needs to have a window. So there's going to be a whole bunch of unused space in the middle of it, and you have to be really creative with that. There's also different thresholds with construction. So an office building doesn't need to have as thick of walls, I believe, as multifamily. And you need to run different heaters for all the units. You need to run waters for all the units. So they have to add a lot more into the walls too to make that work. So if you can find the perfect building, it's great, especially like we've mentioned, Seattle, the office market's struggling, but they're hard to find. You can't do it everywhere. I think it's more common in New York, but I'm not licensed there, so I don't know exactly that market. But I think they started that over there in 2021, earlier on than we did here.
Well, the one that you're referring to that you worked on,
Mhm.
was that just a very unique property that allowed for an easy conversion, or did you find some challenges there, like that interior space? You had
That
to,
one was an easier property. It was a skinnier building, so they
yeah.
could do longer units with more windows. And it's in a good location. If people are familiar with Seattle, it was in Lower Queen Anne. And there's all office that was there has kind of been trying to move to downtown when rents got cheaper because they wanted to be in downtown in general. And yeah, that was just, they're kind of diamonds in the roughs to find the right property to do it with. But if you do find it, I think it can be really beneficial. You just have to be ready for a long ride with permitting and financing and construction.
Have you heard or seen anything? I'm curious about that interior space. How do you get the comps to come in right when you're taking that interior space, or find alternative uses for it to justify it?
Yeah. I think this one I was working on, they were going to use that interior space as elevator bays and stairs. Obviously, that's a
Yeah.
common one, but also do like a conference center for people to rent out to work in, or a kind of social area where people they could have a kitchen or something, and it's like a space where if you wanted to have a party with your friends, you could rent it out. I think that's what people try to do. or they'll try to find buildings where they can do more unique configurations of units and extend them and make them maybe longer and skinnier and try to make it that way.
Got it. Yeah, so
Mm-hmm.
I can see that tenant. It's one of those things somebody's coming in and say, "Oh, look at these great amenities we have. We've
Yeah.
got a gym
Mm-hmm.
here. We've got the conference room there."
Yeah. So you
Interesting.
can do different things like that.
So with the appraisals on the properties, all right,
Mm-hmm.
2026 economy, all right, how much does the credit worthiness of a tenant move the needle for you right now? So if you're going to appraise a building, are you looking at the tenants that are in the building to determine, hey, this is a mom and pop, they've been operating here, but the risk that they're going to go out of business is higher versus someone else that's more established? Does that play into the grid?
Yeah. No, it definitely does. A tenant's ability, like their credit or their strength, is really important. And also how well the lease protects real income over time. So if we have a tenant that's been in there 15, 20 years, they've been on 5-year lease terms, they renew every year, and they might be a local tenant, so they might not be really high credit worthiness, but they've been in there for so long, they've been doing well. We're going to value that more important to the landlord than a tenant who's been in there for a year and is a new business and hasn't extended a lease before or had a storefront before. Those are definitely important to us. I mean, there's no real adjustment we make for that other than if they have a whole bunch of newer tenants, the cap rate might be a little higher to reflect that risk of those tenants.
Got it.
Mm-hmm.
So, say an investor is in a situation where your appraisal comes in and it's lower than their contract price. So, what do you tell them? What would you say to them? What should they do to provide you something to help them find missing value to get that thing back up?
Yeah. Well, typically investors seem to think the property is worth a lot more than it may
Absolutely.
actually be.
Yeah.
And so our job is just to provide the most fair market value, which is what any person coming in would pay for it. And the best thing investors can do to get that value and make sure we don't miss anything is to provide us with the best information possible. When I get an appraisal report or an assignment, the first thing I do is I'm going to ask for a whole bunch of information, and it's going to annoy them and they're not going to like it. And I'm going to keep bugging them for it, but I need all of it to complete the report. And I don't want to be bugging you just as much as you don't want me to be bugging you. But I'm
Yeah.
going to ask for things like a title report. And I'm going to figure out, are there any easements or other things affecting this property that I don't know about, that you might not even know about, because not many people read through their whole title report. I'm going to ask for environmental reports and make sure there's no environmental contamination. I want a site plan so I can see exactly what the site looks like, because I have to count all the little parking spots and everything, and it is so much easier if you provide me with that site plan. I'm going to ask for a floor plan so I can see exactly how much square footage each tenant occupies, because so many rent rolls or leases and floor plans are different, and I have to reconcile between all three of those and figure out which one is actually correct. And I'm going to ask for the rent roll, which will have what you think they're paying, but then I'm going to read through the lease and make sure all the information reflected in the rent roll is accurate. And then I want income statements from the last 3 years, and I want to see how much you're paying for utilities and it broken down correctly, how much you get in rent, how much you get in expense recoveries, how much you're paying in each little thing. And then I'll look at expense comparables and I'll see, oh, are you paying really high for taxes compared to a similar property in a similar area, same size? That is a red flag. Or if your utilities are really, really high, it's some sort of mismanagement going on that you might not even notice, but I have access to that data. And then what else am I going to look at? That's pretty much it. If you're renovating something, I need to see the total budget, what's been spent to date, any plans. I need to have exactly what flooring, windows, etc. you're putting in there, the cabinet type, and when it's going to be done. I want you to send me any sort of permit information you have. And a lot of this is stuff I can figure out, but it's so much easier for me and you if you present that all to me right away in a kind of organized, timely manner.
Which gets to the point that, when you're working with people who have all this together
Mm-hmm.
versus someone who doesn't, I would say part of when you're appraising that or you're working with that individual, you're thinking they really don't know what they're doing. Does that factor into this at all when you have those two different people that are
To an
involved?
extent,
Yeah, I can
yeah,
see
I
that.
don't have to ask you so many questions, and I can create a much more accurate report because you have all that information and you have it set up in a way that works and makes sense. If I don't have to go fishing for it, I'm not going to miss anything. But also, I have owners who have no information at all. They have no leases, nothing. And then I have to go and make guesses on what people are paying or what their expenses are. And that just decreases the reliability and the accuracy of my appraisal report for each little thing you're missing.
Can you think of a disaster story, someone you were doing an appraisal for and it just all fell apart because they screwed up?
Not so much as screwed up, but there was a property I was working on in Bremerton, which is in the South Puget Sound. It's kind of a naval base area, and it was a commercial property, and they had zero information, nothing. So when I write the report for the bank, and I think they were on the edge of defaulting, so I think they didn't want to work with me personally because that just got the ball rolling and meant it was closer to that.
Time to lie on it, yeah.
Yeah. So I had to make a statement. It's called an extraordinary assumption and say, I have no leases, no rent rolls, no information. They are refusing to answer any of our questions. So this is our best estimate at what this property could be worth. Or another time I was working on a mobile home in Snohomish County, which is north of Seattle. And every document they had was printed out. No other copies or anything. So the property owner, going back to the 80s, he gave me a huge stack. And he goes, here you go, I'll need it back at the end of the appraisal. That is so much harder for both of us because I have to drive back up there after I'm done with it, making scans of everything and give it back to you. But I probably didn't need 95% of that information. And you're just letting me take it and hold on to it for the 3 weeks I need to do this report or 4 weeks or however long it took. And it's so much easier if you have everything set up and it's easy to send and I don't have to bug you for it. The process is going to go so much smoother and you're going to get your appraisal on time and it'll be as accurate as possible.
So I was going to ask you, for the viewers, what is one piece of advice you would give them before starting to work with the appraiser? And it sounds like get all your paperwork in order because the more they provide you, the easier it is for you to do your job. But it's also, they know more about this investment, obviously, than you will. And so they can give you then opportunities to say, hey, yeah, the value here is much higher than what you might find on a comp. Is that correct?
Yeah, exactly. If it's organized and well thought out and it's all there, I don't have to bug you nonstop. I can start on my appraisal right away, where sometimes I'm bugging someone for 2 to 3 weeks and I have a 3-week timeline from the bank. My appraisal is going to be so much more rushed. I'm not going to have time to ask you all these follow-up questions if you don't send it to me as early as possible. And that's why we bug you, because we're trying to get you the most accurate report we can. But some people just do not understand that.
I know, it's just like on our tax side of our business, we probably do close to 15,000 tax returns a year. And individuals that we work with who are in that same boat, hey, they send us all their information, their organizer, 2 days before the filing deadline. And they want miracles to happen. And as you stated, you can't do it because you don't have that opportunity to go back and forth and really get into the data itself and find opportunities for them.
Yeah,
so,
exactly.
That is a phenomenal piece of advice. I hope people pick up on that. So anything else I didn't ask you think that the viewers should know?
Oh gosh. I mean, do you think most of your viewers know how appraisal works and the different parts of it and what they can be used for? Because that's, I think, important to get into.
Let's talk about that.
Yeah. So there's 3 main types of appraisal reports. The first is a narrative report. that is most of my work. It's the really long 50 to 100 page reports, sometimes even 150. Most of mine are on average 80 pages. That's what I perform for most of my clients, like banks or lendings. And then the next type I do, the next most common, is restricted appraisal reports. These are less detailed. They're 15 to 20 pages before the addendum. This is what I would do for non-bank clients, like a lot of our viewers here that are looking to value their portfolio, do an internal review. Then the last main type of report is a form report. So this is what residential appraisers do for mortgage lending. It's probably what most people are familiar with. It's just the one page. They have a couple boxes. I do not perform those. That is residential appraisers. And these reports can be used for anything from lending and financial decisions to purchase and sale transactions to even taxation purposes. If you want to do a property tax appeal, I've done restricted reports for those, and they've lowered their property taxes because their property taxes were going up $5 to $7 million a year for an apartment building, and that was just crazy. So you can use them for so many different things. And then there's three main approaches to value in an appraisal report, and we've kind of touched on all three of them at different points, but I haven't really broken them down. The main one, the one we use the most common, is the sales approach. So that's by valuing the subject by comparing it to similar properties that have recently sold. That's where that adjustment chart that we talked about comes in. So I look for those similar properties, and then I make adjustments based on things like sale date, sale conditions, location, size, parking ratio, etc. And then I reconcile the adjusted prices to form my opinion of value. And this one is really good because it reflects what buyers actually pay in the market, but it's weak in more rural areas or areas where there's not that many comparable sales. So we often also do an income approach, which values a subject based on its income producing potential. So this is that annual net income divided by the cap rate, which we've kind of touched on. Mm-hmm. And how it works is I look at the subject's rent roll and leases, and ideally I have those things. And then I determine if contract rent is near market rent, so near what any person would pay to lease a space. And I do that by looking at comparable rents in the area. And then I either use market or contract rent in my report. If the market rent is way below contract rent, so tenants are paying way more than any other typical tenant would, I'll use market rent because that's overvaluing the property if I use that contract rent. Or if I'm doing a leased fee appraisal, that means I'm using contract rent. And if I'm doing a fee simple appraisal, I'm using market rent. And then after the rent that I have for my base rent, I'm going to analyze the property's expenses. And hopefully I have that detailed expense history from the last 3 or more years, but I'm also going to pull comparable expenses from similar properties, and then I'll reconcile my projection in between the two. Like I said, if the subject's utilities are really high or really low compared to the comps, I'm going to go somewhere in between the two because that's showing some sort of difference that the market isn't supporting, and it's probably a management issue. And then I'm going to look at cap rates. So I'm going to try to find similar properties and look at investor surveys like from PwC and come up with a value from in between those two. Obviously, I want to find similar properties in the area, but sometimes if I'm working on a school or something that not a lot of sales happen, I'll do the whole West Coast or I'll do the whole country. It just depends. Like data centers, we kind of look at the whole country because they don't sell that often because they're newer. And then we divide that NOI by the cap rate, and that gives us the subject value. This is really good because it reflects your investor's behavior, but it's hard because you need that reliable income and expense data. And like I said, a lot of property owners don't give that information to us. Then the last approach is the cost approach. And we talked about this right at the beginning. It's the cost that it would be to reproduce or replicate the improvements today, minus the depreciation, and then we add back in the land value. And we determine land value by using the sales comparison approach. So we find similar areas, sales in similar areas with similar zoning of similar size, and then we determine the cost using a cost manual. We use Marshall and Swift. It comes out every month. And it makes, let's say I have a class B office space. I would say it's a class B office space. I'd go to that page in the manual. Then I would choose if it's average, good, excellent, and then make adjustments based on that. And then you make a location adjustment. So for in Seattle, costs are higher than most other areas. So it might be 1.26 above the normal cost throughout the country. And then then I'll make depreciation adjustments. So we talked about functional obsolescence and a little bit about external obsolescence with the economic market condition adjustments. We haven't talked about physical depreciation, which is your general wear and tear. Every building, when you're going to find what it would cost to reproduce it, it's not going to be brand new. We have to adjust for how long it's been there, how well it's been taken care of, and that's that adjustment. And then finally, we add back in that land value. This is really good. We use it for new construction or special use properties like churches. And it's great when there's not a lot of sales data. But the hardest part with it is determining the depreciation, because 100 different people could have a very different opinion on what each item of depreciation could be for a property. And then at the end of it, I reconcile between, if I'm just doing the sales approach for, sometimes we do houses, but most land, I'll only perform that one. So that'll be what I reconcile at. But typically when I'm valuing a commercial property, I'm doing just the sales and the income. We're going to reconcile a little closer to the income approach because investors typically rely on that. And most people buying and selling commercial properties are investors. And we really only do the cost approach, like I said, if it's a brand new build. So we'll do all three approaches if it's a brand new build and reconcile somewhere between the three. But if it's a church or other special use like a school, we're going to reconcile between the cost and the sales, but lean a little bit towards the sales because a lot of owner users will buy those types of properties.
You bring up church, and it just brought back a memory. So about 20 years ago, I bought a property down in Savannah, Georgia, a warehouse. And the idea was we're going to go in and tear it down and build something there, a mixed use property, put in some restaurants and things like that. Well, when we go to get our permitting, found out that across the street, this little trailer, it was a mobile home, was an actual church.
Oh.
Didn't even know that. And I mean, who would expect that a mobile home is a church? Maybe they have a congregation of 6 people. But the fact that it was a church, the local zoning laws prohibited the sale of alcohol within, it was a 1 mile or half-mile radius. And we're just right across the street. So it totally scrapped my entire plans for this property. We ended up keeping it as a warehouse. But it's one of those weird things that you don't know. And it just brought to my mind, when I went in, I did this deal. It was one of the very first commercial deals that I've ever done. I didn't think about hiring an appraiser to go in and look at that stuff. So my question to you, is that something that you would look at if I said, hey, I'm thinking about buying this property? Give me a quick appraisal on it. Would you be able to go in and find, and I tell you what I want to do with it? You'd say you can.
Yeah, it's definitely something we will do. When we appraise a property, we're always looking at the highest and best use. It's one of the categories of an appraisal. It's something we have to determine because if it's currently operating as an office property, but I think it makes way more money as conversion of multifamily or something like that, I'm going to appraise it as if it was converted to multifamily and then deduct the cost to do it because in theory, if that is the highest and best use, it should still be worth more as that than if it as is. So we always do the highest and best use as if it was vacant land. So with that, I go into zoning, I go into the land, the site, the traffic, everything that makes the site what it is. And I'll read that zoning code in detail and see what's allowed. And then I'll go to something like CoStar and look at different vacancy rates and different market rates and where rents are going for different property types. And that'll help me hone in what should be built on that property if nothing else existed. And then I'll go into the highest and best uses improved. So if it's an underperforming property, it might not be what it is currently operated as. It's probably going to be something else or conversion, or it could even be tear down, or it could be to renovate it and increase rates. So that's definitely something you could do for before.
So what I'm hearing, and I hope other people are hearing this as well,
Hmm.
Hire an expert like Megan to help you figure this stuff out, and don't do what I did, right?
Yeah.
Just say, hey, I'm getting into real estate now and I'm going to go out and buy a commercial property. So it's my first commercial building. Bad decision on that one.
It can be. Yeah, we
Yeah,
spent a lot of time reading zoning codes. Like in your situation, that would have been helpful because I know what to look for. And we spend a lot of time looking at data. All I do all day basically is write research reports. And most people are not spending their whole day doing that. So I have a lot of information stored in my head and in all my files and all my past jobs I've done.
yeah. Well, that's awesome. Hey,
Mhm.
if I want to thank you. Is there any resources that you have at Kidder that if people wanted to learn more about the appraisal process or things that they should, like FAQs, or that could help a real estate investor that you could point them to?
I don't in general. Our website has my contact information if anyone has questions, and I think you guys have that information as well.
Yeah, I'll put it in
Um,
the show notes.
yeah, but the Appraisal Institute is also our national kind of governing board, and they have a lot of good information for more general questions like what is an appraiser? What is an appraisal? All these weird terms I'm throwing out. They put out a lot of information on that because their main job is to create public trust in our industry because a lot of people have no idea what we do and they do not understand it. So they're just trying to help people trust us and trust our valuations and understand what we do. Those are probably the two best resources I could think of.
Awesome.
Mhm.
Megan, thank you for coming on and sharing this valuable information with the viewers about the appraisal process. Is there anything you want to say in closing this out?
I don't think so. Thanks for having me on, Clint. It was fun to talk about it. I don't get to talk about my job that often, so I enjoyed it.
All right, take care. Thanks.
Thank you.